Okay, very good morning to all. Wednesday the 24th of May. Let's get the briefing underway for this morning. And just taking a look at the closes when I first came in on Wall Street. The S&P finishing up marginally last night, about 0.2%. Puts us actually, in terms of the S&P, and it was a positive finish across all three major indices, puts us back to about 0.3% from all-time highs again in the S&P. You know, what a difference a week makes. Remember when it got to Wednesday, we were all discussing the legality of impeachment, and then here we are back within striking distance once again of all-time record highs. This coming as well amid one of the world's largest economies, China, being downgraded overnight. One particular point I need to give a shout out to one man in particular who at this particular point I've just circled, none other than our very own Sam North, the Oracle, correctly predicting EU referendum, the Trump victory. He tweeted at that point, "We're going to be at all-time highs this time next month." Not a bad job, Sam. This happened a little quicker though than probably even you would have imagined. But case in point, the market had a big move to the downside last week, and a lot of this I think tends to become almost self-fulfilling in a way, in that we start to break some interesting technical levels to the downside. The VIX at that point, if you remember, was tracking at levels really not seen since around the early 90s, so considerably low levels of volatility. So when you started to get a bit of a pickup in activity and volume, certainly it kind of snowballed and momentum picked up, and we had a fairly decent day, or consecutive days at the beginning of last week, of selling pressure. That, in combination with a series of articles kind of coming out, all talking negative about Trump. But reading my Twitter feed on the way in this morning, the White House were making comments last night saying there is no evidence of any wrongdoing. This obviously comes ahead of the Comey hearings and so on and so forth, but not wholly surprising to hear the White House say that officially is the statement. But the market seems to, at this point, have got over any brief concerns that came amid some uncertainty about Trump's future. Certainly this kind of Middle Eastern tour that he's been on, having been in Saudi Arabia at the weekend, Israel yesterday, he's in Europe at the moment, then he's got the NATO summit and G7 meeting at the end of the week. So far, so good in respect that he's not really done anything out of what someone of more political experience would do. So he's actually had a fairly measured approach to the situation, and maybe the market has taken a little bit of the sting out of this growing uncertainty that was surrounding him just last week. So equity's back up there at the moment, and if we're looking just in terms of the overnight performance, finding a bit of support on the SPOOs at the pivot level. But overall, looking at these charts, I can see that there's not really a great deal going on. Certainly in the FX markets, the dollar's flat, euro dollar and cable reflecting that. A bit of upside resistance found at the pivot level at the moment, which is at 129.91, obviously about 10 pips shy of the psychological 130 handle. Crude as well, just kind of holding pattern, which is what we've been talking about really the last 2 days. You've got the OPEC meeting coming up on Thursday, which is tomorrow. So as we get in toward this afternoon, I would be just looking out for any potential doorstep comments as the various oil ministers and their teams start arriving in Vienna. They do have quite a familiar pattern of leaking to the press exactly what it is they're going to do, but as we well know, the likelihood is, and the reason why we're up at these kind of 51.5 type levels in WTI crude is because we're expecting a 9-month extension, which of course is an additional 3 months longer than their previously defined agreement. So I'd expect oil to really sit around this price point for much of the day until we get more concrete answer tomorrow on whether that gets confirmed. We did have a bit of volatility. I can see here this kind of large wick either side to actually close out this 15-minute candlestick pretty much exactly where it began. So this kind of screams out to me this is inventory data, and of course we had that last night. This was the API crude oil inventories. A quick look at that and the numbers, because this will act as your reference point for the Department of Energy report later this afternoon. You had a crude drawdown of 1.5 million. That's actually not too far from consensus. A 500,000 kind of away from the median consensus is fairly in line as far as the crude numbers goes. Cushing a drawdown of 210, gasoline a drawdown of 3.15 million, but expectations were for just a draw of 1, and distillates a draw of 1.85 million. The 7th weekly draw in crude inventories in a row. I guess then the drawdown in the headline not quite as deep as expected, but the gasoline a much bigger draw, hence probably that's what led to the fairly whipsaw price action since then. A lot of people as well, I'd say, are probably uncommitted. No one's going to really be to jumping into the market trading this too much, just given the fact that there's bigger priorities at play for this week, and that being the OPEC meeting. So that will kind of take precedence in the hierarchy above the inventory situation, at least. Particularly as well in a crude inventory environment on the headline where we've had a 7th weekly drawdown. It's a fairly consistent pattern there, and people have kind of factored that in to some degree. Okay, quick look over some headlines. This is probably something that you would have read about last night. UK's Theresa May has warned further terrorist attacks could be imminent. Essentially, the security level and UK terrorism threat level in the UK has gone to critical from severe, which is the highest level for the first time in a decade. Just before I kind of get into the meat and bones of this, first of all, I hope I don't sound insensitive when I talk about these types of issues like the terror attack. Obviously, it is a tragic event, but I wouldn't be doing my job if I don't explain these types of things to you in terms of how they impact the market. So, a couple things to just keep in mind with this type of news. The one thing is, in terms of how the markets reacted to the actual Manchester event, it was minimal. As I've probably explained to you before in kind of trying to understand the impact of news, markets have become almost desensitized to these types of events because of the regularity that they're now happening on a global level, and expectations are that unfortunately these things will continue to happen in the future. The one thing though that this will lead to, and something which we saw yesterday, is that because of this heightened situation of security, you tend to hear more reports about investigations into suspect packages, precautionary evacuations, and so on and so forth. So it is something you'll probably hear the squawkers talk about, and so just to keep you kind of in tune with that. I did have a question from one of the guys today about, is this going to affect then the way people are going to vote? You've obviously got the general election coming up very soon, the 8th of June. Would this have any influence on people's feelings towards either, I guess, Conservative or Labour? And given the fact that the polls, as we know, have been converging, i.e. Labour have been catching up, how does this affect things? And I guess looking at it for what it is, in terms of Theresa May gave a speech last night, and it's not that people particularly like Theresa May. I think that the surveys that have been done canvassing the people of Britain is that they respect her, not so much that they like her. Whereas Corbyn, apart from this kind of latest social media phenomenon of grime for Corbyn, I would say Corbyn's popularity is absolute disaster. It's Labour policies, if you like, that they've been trying to push towards people to focus on, rather than Corbyn himself, until this latest kind of online kind of buzzwords being in circulation. But I guess in this situation, if there is terrorist attacks, if anything, I would say that only probably lends its hands to someone like Theresa May, which people would have more confidence in a leader with authority on these types of situations. Whether or not that will translate into the polling, I probably don't think so. Whether or not that will translate into any movement for the pound, I definitely don't think so, because the gap still is towards a majority for the Conservatives. Just on this point, I did see a very interesting graphic, and I just wanted to quickly share it with you. And I know it's my kind of job as an analyst to look at these things, and people might look at it and go, well, you know, polls are polls, what do they mean? They were inaccurate the last time in general elections, and that's fine. But you know, one of the things I would say is that in the French elections, they were pretty much right on the money in terms of the first round calling for Macron runoff with Le Pen, and then the actual result at the end in the second round, they were some of the most highly accurate polling that we've seen in a very long time. And one thing is that methodologies, since the kind of inaccuracy that we saw back in 2015 election, methodologies have been changed and updated to accommodate and to improve the possibility of trying to eradicate inaccuracies. So one thing that I've seen this morning is looking at an interesting statistic here, was that only once in the last half century have the Tories won a lower share of the vote than the average of final polls have suggested. So if you're looking at statistically speaking, it's the polls tend to be fairly accurate when it comes to specifically the Conservatives, and Maggie Thatcher was probably the last time, going back to 1983, when she was on course by the polls for such a large-scale kind of landslide victory. This is when it was against very major radical left-wing opposition. One of the things here, looking at this chart, is that was Margaret Thatcher era, so this was 1983, and this is where we are at the moment. And the question being, can we trust the polls? And we've seen the YouGov, which is probably the narrowest spread at the moment, which is about 9 percentage points. Their modelling would suggest a slightly wider Tory lead than the current polls. So that's the model, there's the polling at the moment. But you can see here, this is 0. If it was to be a Labour victory, obviously this would need to be down in the negatives, and so we are far away from that at the moment. So comparative, the average poll of polls, which is probably tracking around 11 and 12 percentage point difference between the Tories and Labour, the model would suggest it's more like the mid-teens. One of the other things that they do here, the pollsters, in order to gain greater accuracy, is they'll look at different things. So they'll look at actually Ipsos Mori series about confidence in the leader of the party. That's factored into the equation, and there's a 24-point lead for Theresa May, because obviously Jeremy Corbyn has been one of the least popular Labour leaders of recent times. The other things as well, that's a really important calculation that people might have forgotten, was you had the local elections only about 2 weeks ago. And if you remember the local elections, it was an absolute landslide for Conservatives. And so that actually also gets factored into the calculation to predict then, along with just general sentiment polling of canvassing people, to give you this kind of mid-teen average prediction of how much the Tories would win by. How does that translate? Well, the kind of slim majority that I have at the moment would be, I think, bookies spreads are something like kind of 60 to 80 type seats, rather than this kind of 150 runaway, just given the slight closing of polls. So just thought I'd point that out. And then this kind of leads us on to another story which I've seen this morning, and one of the things we've been looking at, well, if I just flip my chart, is the pound. And we've talked a lot about how the negatives seem to be stacking up from a fundamental perspective for sterling currency. Given the fact that inflation is rising, and given the fact that there's maybe not so clean-cut majority that the Conservatives might have. Remember, it was in excess of 20 percentage point lead when the snap election was called. However, since that point, and that was why we rallied so strongly here back on the 18th of April, but then we kind of gone fairly sideways. Inflation has picked up. We've had some a bit of volatility on some of the recent economic data points, but now it's kind of, where do we go from here? And one of the interesting things was that although inflation typically would lead to sterling appreciation, people are starting to look beyond that as to how much is this going to continue to affect the consumer going forward. if that dampens their ability to spend, that will have a detrimental effect into the cycle in terms of UK economic growth. So this then leads us on to something I saw in the press this morning. So this is Blue Bay Asset Management. They have something roughly like $55 billion, I think, under management. But just quite interesting, they've basically taken this opportunity at these levels around 130 and they've gone short. They're basically saying that whatever the outcome of the election doesn't really matter. The bottom line is that the UK it's going to be a hard Brexit, in the sense that the market is not giving full credibility to how difficult the job will be to negotiate a smooth Brexit, and that the government is being too complacent in that regard. So the average here, what you're looking at is the average on Wall Street for where cable sterling dollar would be at the end of 2017, and we're trading about 130 at handle at the moment. So most people are predicting that, given the difficulties in negotiations ahead with Europe, given how inflation is going to affect the consumer, cable ultimately will decline. That is the benchmark or baseline scenario view. But Blue Bay obviously getting a little bit more aggressive with that call, and they're looking for that 120 push by year end. So they're one of the more bearish on the street. If you start factoring out, let's look at cable slightly longer term, that 120 is a key target for obvious reasons. It was that 120 which defines the bottom end of the Brexit kind of fall. Got it marked up here from previous conversations, the referendum itself, the hard Brexit calls from Theresa May, but 120 is the bottom of the band, if you like, that we've been trading on this 10-point range at the moment. So Blue Bay looking at this point to get short all the way down to 120 year end. So pretty bold call, but I would say that most are anticipating at least a pullback in the months ahead. Okay, one of the other things that has dominated some of the headlines this morning has been China has been hit by its first Moody's downgrade since 1989 on debt risk. This did consequently lead to this, or this was firstly the reason: China's total debt as a percentage of GDP. If you think about what Trump's trying to achieve by spending his way into US economic growth, well, China have been at that for many years. China, a country which is used to growing in excess of 10% for such a long period of time, declining to 6.5%, created a fear of a hard landing, even at 6.5%. This was at the beginning of 2016. So what does the Chinese government tend to do? They do mass, large-scale infrastructure building that continues to kind of fuel the economy and demand, so to speak. But where does this come from? Well, this is predominantly bankrolled by taking on further debt. And so the debt to GDP ratio continues to increase. Now, overnight, the Shanghai Composite, I think it did print several month low. So Asian equities certainly did feel a bit of a brunt of this. And so what else did move lower overnight? Well, in the FX market, if you're looking for the proxy for appetite or risk sentiment around China, concerns on China results in weakness into the Aussie dollar. This is looking at the Aussie future, came under some concerted selling pressure as the Asian indices, predominantly Chinese indices, came under selling pressure, albeit we have seen a bit of a bounce here. So why have we bounced in the Aussie, and why has the market brushed aside this information? Why do they largely not care that China's just been downgraded, which is one of the world's largest economies? Well, a couple things for you to consider. First of all, what I've got here is a table of sovereign debt ratings. And for some of the new guys, just to give you up to speed of kind of what this means. So there's essentially three major global rating agencies. There's Moody's, who downgraded China last night. There's Standard & Poor's, or S&P, and then there's Fitch. There are also, I'd say, two others that you should be aware of. One is DBRS, which is the Canadian rating agency. That's sometimes viewed more closely by European bond traders, as actually when you're looking at the collateral quality that's used in ECB operations, the ECB does focus on 4 rating agencies rather than just the 3. The other rating agency to be aware of is one called Dagong, which is the Chinese rating agency, but people's, I would say, in the Western world don't look at them with such credibility, because lo and behold, how do they rate China? Well, they rate China quite high, they rate the US a bit lower. It's kind of a little bit political in that sense. So really it's these 3 that you're focusing on. It's Moody's, it's S&P and it's Fitch. Now, as you can see here, all these different countries essentially have different alphabetical and plus and minuses. So what does this mean? And if we scroll down to here, this is just a brief introduction to the rating grades kind of legend. And so what you can see here, the 3 major rating agencies, you've got Prime, which is the most highest rated sovereign rating, so AAA, high grade, upper medium grade, lower medium grade, and then you get into the reds, which would then be classified as junk, and then C right at the bottom being default. So if you think about the bottom half, you think about someone like Greece. Greece obviously could become a point if they do not manage to come to some kind of compromise and agreement with their EU creditors. They could fall all the way back into default. But certainly they're in this junk quartile, if you like, of the table. Now, what you need to put into context here is the current ratings. So this has not taken into account the change that happened last night. But what I'm looking at here is this is Moody's previous rating. First of all, what does negative mean? What does stable mean? Well, again, refer back here. Negative, what that means then is anticipated that credit rating may be lowered in the coming 6 to 24 months. Positive, the same time frame, but the other way round. What happens then is whenever a sovereign rating is issued, the rating agency will review it every quarter, and between the period of 6 to 24 months, if they're seeing it as negative, it means that there's a possibility of a downgrade coming. They'll review that, so markets are already kind of aware of what the situation is. Now, looking at what the other rating agencies, so if I go back to the bar here, the middle column is S&P, the far right is Fitch. If we go back to China, let me just see if we can get the legend in here as well. So at S&P, they had them ranked at AA minus. AA minus is here. Then if you look at where Fitch had China, is at A plus. And A plus is actually dropping all the way down to the upper medium quartile, or upper medium grade. Last night, China got downgraded basically from high grade down to A1. So in essence, China has just been downgraded to the same level at Moody's as is already in place at Fitch, and just 1 notch is above his S&P. So in reality, in context, yes, it's the first downgrade Moody's has issued on China since 1989, but in reality, the other rating agencies like Fitch are already down at that level. So broadly speaking, it's the press making a bit of a mountain out of a molehill, in my opinion, and as you can see, the markets have largely brushed this aside. Now, that's not to say that Shanghai Comp didn't see volatility overnight, but I think that's just more kind of short-term speculative reaction to this. At that point, we're still high-grade investment in terms of quality, so China shouldn't have any problem still in terms of accessing money at that credit level. So I don't think that's a particularly big story that's come out overnight, personally. I don't think it's going to be something that's going to impact these markets as we go through the session today. One other story, just to get you up to speed on, is the ECB. And I think the ECB have been quite interesting at the moment, because with the euro up at around this 112 level, we've started to have some movement towards monitoring of ECB commentary has become important again. Why? Because are we getting at a point where the ECB starts to get the ball rolling on coming out of such an accommodative period of monetary policy? And what you're getting is some slight divergence appearing on some of the more senior officials at the ECB. What you've had here is on the 15th of May, ECB's Prayet warns against changing stance abruptly. So this is kind of more dovish, if you like, whereas on the 18th of May, So just a few days ago, ECB's COER cautions against too much gradualism. This is the opposite. You risk falling behind the curve if we go too slow, is what he's basically hinting towards. So I would say ECB commentary is going to be quite key going forward, and I point this out because if we look at the actual agenda on the ECB press pack for today, there are in fact two speakers. So you've got the slightly more dovish leaning, going off those last comments, Peter Pratt. He'll be speaking later on, giving a keynote speech in Bulgaria. But then you've also got ECB President Mario Draghi is speaking today at 1:45. In terms of the topic, keynote speech by the President at the first conference on financial stability. So it's not so much on the economy or monetary policy, but in this type of situation where people are looking for subtle wordplay as a hint towards potential future action, I would definitely be monitoring when the President is speaking. Text will be made available on the ECB's website, so the likelihood is we'll be able to get access to that report pretty quickly as well upon its release. So definitely be on the lookout for that. Okay, quick look and review of the calendar. And for this morning, there is not a great deal going on. Apart from the ECB speaker coming up at 9:30, from economic data standpoint, very little is happening until we get into the afternoon. We had new home sales yesterday out of the US, which was a slight miss on expectations, but it was coming off a previous 10-year high in the last month's report, so didn't really have too much of an influence on market sentiment. We'll get the building permits coming out of the US at 1:30 and existing home sales this afternoon. For any currency traders though, always an interesting and volatile affair is the Bank of Canada interest rate decision. Nothing to do with rates. People are not expecting this to be changed. What they are expecting though is, again, assessment on the economy. The way that Canada works is they'll release a full statement on monetary policy and economic conditions alongside that rate decision. And then following the APIs last night, you'll get the Department of Energy crude oil inventory numbers. They'll come out later this afternoon, and so we'll be recapping those as well. One thing I've just seen here on the calendar as well, one final point to be aware of, former FBI Director James Comey is giving a speech. That'll be at 3:30. Of course, that will be probably interesting. Could have the potential to move the market. The point being here, what evidence has he got about Trump's intervention, if you like, into his investigation? If there is credible evidence, then obviously we could see sentiment change quite negatively quite quickly. But at this present point in time, as I'm speaking, S&P looking to come up to yesterday's highs, which were just short of that 2400 psychological level. Okay guys, going to leave it at that. Coming up to 9 o'clock. So that's your morning brief. Going to wish you a pleasant day. Have a good session. And I'll see you in the chat room. Thank you.